Welcome to the Deep Dive, the show that's all about cutting through that information overload and giving you those crucial insights you really need. You know that feeling, right? Staring down a mountain of information, especially if you're prepping for something like a big case-based exam in auditing.
Oh, absolutely. It's intense.
Yeah, and it's not just about memorizing facts, is it? It's about applying them under pressure, connecting all the dots
Yeah.
in, a complex scenario. It's so easy to feel overwhelmed.
Drowning in details.
Exactly.
Yeah.
What we all want are those aha moments, right? Those times when it just clicks, turning abstract stuff into something you can actually use.
And that is precisely our mission today. We're going to give you a proper deep dive into 3 absolutely critical standards on auditing essays, as they're known. These are fundamental to the whole completion and review phase of an audit. We're talking Essay 560 on subsequent events,
Right.
Essay 570 on going concern, and Essay 580 written representations. Our goal isn't just to explain them, but to really unpack why they matter, show you how they actually link together in practice, and most importantly, equip you with that application-based knowledge you need for success, just like you'd face in those tough exam cases.
So you can actually use it.
Exactly. We want you to walk away understanding how to use these standards, not just what they say.
Okay, so buckle up. This isn't just going to be a dry run-through of definitions. Think of us as your guides.
Yeah.
Navigating the tricky bits, connecting the dots for you. So you're not just learning rules, but really getting the practical side. We're going to the nitty-gritty, looking at how auditors apply this stuff in real dilemmas, like in those case studies.
That's the key. Understanding these standards deeply allows for that critical thinking in real-world scenarios. It's about moving past just memorizing to really grasping why these procedures are done, what challenges they address, and, what the implications are for the financials and the audit opinion. It's where theory hits the road.
Okay, let's unpack this first bit. We're talking about the completion and review procedures in auditing. You see, an audit isn't over just because you've looked at transactions all year. As the auditor, you've done your testing, your analysis, but before that final audit report goes out, there are these last absolutely crucial steps.
The final frontier, you could say.
Yeah, kinda. These procedures are like the auditor's last look, a final sweep, making sure the financial statements show everything significant right up to the moment that report is signed.
And checking those fundamental assumptions underpinning everything are still appropriate.
Exactly. It's about pulling it all together for that final opinion.
And what's really fascinating and crucial for understanding this phase is how interconnected these specific standards are. Essay 560, 570, and 580, they don't operate in isolation.
Right. The outline mentioned they're pictorially linked.
Precisely. Don't think of them as separate checklists. Imagine them more like interlocking gears. What you do under one standard often directly affects what you need to consider under another.
So, like, a subsequent event could raise a going concern issue.
Exactly. Or both might need specific written confirmations from management under SA 580. They form this coherent, integrated set of final checks. It ensures you have a holistic view before signing off.
Okay, to really bring this to life, let's use that illustrative story from the source material. The predicament faced by CA Sujatha M.
Ah, yes, the auditor dealing with the manufacturing company.
That's the one. They make energy-saving electric lights. Now, here's where it gets really tough for her. During the year, a massive fire completely destroys their manufacturing plant. Building, machines, stock, everything. Gone.
Wow, and the loss?
Estimated at a staggering 50 crores. The company lodges an insurance claim, obviously. But by year end, when Sujatha is deep in the audit, there's been absolutely zero progress on settling that claim.
Oof. That immediately paints a very grim picture. Operations completely shut down, right?
Total shutdown. And they have very little cash to reinvest, making a restart look almost impossible.
And the promoters tried selling personal assets.
Yeah, they tried. But the property market was dead. No buyers. Meanwhile, their customers, understandably, couldn't wait forever. They started drifting off to competitors.
So future prospects were looking bleak, too.
Very bleak. So Sujatha's got this massive issue. The core question nagging her is the company's ability to continue as going concern. Can they actually survive this?
A classic and very serious audit challenge.
Her first approach, under pressure with deadlines looming, was what she called a wait-and-watch policy. She was literally keeping her fingers crossed, just hoping for good news on the insurance claim.
Understandable, but risky. How much time did she have?
About 4 months to finish the audit and sign the report.
Yeah.
So she was playing for time, hoping something positive would happen.
And this is where subsequent events really kick in, isn't it? What happened next?
Well, Just as the audit report date is getting close, devastating news lands. The forensic lab investigating the fire site releases an adverse report.
Oh no, what did it say?
It casts serious doubt on the genuineness of the claim itself. Imagine the shock. For the auditors, for management, this basically crushed any immediate hope of getting that insurance money.
Pushing the company even closer to the edge, that's a classic subsequent event with huge implications.
Talk about a punch to the gut. Now, despite this, management, maybe out of sheer desperation, gives Sujatha a future plan of action and a cash flow forecast.
But she wasn't buying it.
No, she applied her professional skepticism. She found the plans too rosy and impracticable. I mean, how could they be realistic when that negative forensic report had just pulled the rug out from under them?
Makes sense. The forecast wouldn't stack up against that new reality.
But the story takes another turn. Management didn't just give up. They looked closer at that forensic report and found gaping loopholes.
Really? Like what?
Contradictions, basically, especially when you looked at the company's strong track record. Good profits, paid taxes, always expanding, growing demand. It just didn't make sense for them to suddenly commit fraud. So, armed with this, management decided to fight back, challenge the forensic findings and the insurers.
Good for them. How did Sujatha find out about this?
This is key. While doing her routine audit work and specifically her ongoing subsequent events procedures, asking questions, checking for updates, she learned about this challenge.
Ah, so her procedures were actively tracking the situation.
Exactly. She found out management provided a point-wise rebuttal to the insurers, backed up with video graphics and other digital evidence from the site. Powerful stuff.
And it worked.
It did. This new, compelling evidence apparently left the forensic lab red-faced. They had to reconsider.
So a revised report.
Yes. A revised, positive report came out, finally clearing the way for the claim settlement.
That's a huge turnaround. And crucially, this happened before she signed the audit report.
Correct. This positive development, becoming known after the initial bad news but before she finalized the audit, completely changed the company's outlook. It offered a lifeline, mitigating those huge going concern worries.
And the takeaway here, linking back to the standards.
The source emphasizes that Sujatha could convince herself about the ability of the company to continue as a going concern, precisely because she was, quote, particular about performing procedures regarding subsequent events.
Mm-hmm.
Those procedures allowed her to identify the mitigating factors that turnaround with the claim. It perfectly highlights why SA 560 is so critical. Timing and vigilance are everything.
Okay, so let's dive into SA 560 itself. Subsequent events. As you said, time really is of the essence here. The standard deals very specifically with the auditor's responsibilities relating to subsequent events in an audit of financial statements.
Right. It's all about that period after the company's year end, but before the audit is totally wrapped up and the report is issued. That critical window.
Exactly. And the definition of subsequent events is key because it actually covers two distinct periods. First, it's events occurring between the date of the financial statements and the date of the auditor's report. That's your main audit fieldwork and wrap-up time.
Okay.
But second, it also includes facts that become known to the auditor after the date of the auditor's report. So even after you've signed off, if something significant comes up, SA 560 still applies.
Ah, so it splits the responsibility based on timing. Makes sense.
It does. And within that first period, between the financial statement date and the report date, SA 560 distinguishes between two types of events. It depends on when the underlying condition existed.
Okay, what are the two types?
First, you have events that provide evidence of conditions that existed at the date of the financial statements. These are called adjusting events.
Adjusting events. Like something was already uncertain at year end and the event afterwards clarifies it.
Precisely. Think of a court case pending at year end. The verdict comes out after year end, but before the audit report. That verdict gives you better information about a condition, the liability that already existed. So you adjust the financial statement.
Got it. Amend the numbers. What's the second type?
The second type are events that provide evidence of conditions that arose after the date of the financial statements. These are non-adjusting events.
So the condition didn't exist at year end, it happened afterwards.
Correct. Like a major fire after the balance sheet date that destroys assets, those assets were fine at year end. So you don't adjust the numbers on the balance sheet.
But you have to disclose it, right? Because it's significant information for anyone reading the financials.
Absolutely. Disclosure in the notes is crucial for non-adjusting events so users get the full picture.
Okay, so what are the auditor's main objectives under SA 560?
There are two main objectives. First, To obtain sufficient appropriate audit evidence about whether events occurring between the date of the financial statements and the date of the auditor's report that require adjustment of or disclosure in the financial statements are appropriately reflected.
So basically, find everything relevant during the audit period and make sure it's handled correctly in the accounts or notes.
Exactly. That's about diligence during the active audit phase.
And the second objective.
The second one extends beyond that. It's to respond appropriately to the facts that become known to the auditor after the date of the auditor's report that, had they been known at that date, may have caused the auditor to amend the auditor's report.
So that ongoing vigilance piece. Even after signing, if you learn something critical that would change your opinion, you have to act.
Correct. It protects users and the report's credibility.
Okay, let's break down the specific procedures, starting with Phase 1. Events occurring between the financial statement date and the audit report date. What does the auditor do?
During this phase, the auditor shall perform audit procedures specifically designed to identify all such events that could materially impact the financials. These procedures need to cover the period right the date of the auditor's report, or as near as practicable thereto.
As near as practicable. Meaning you do your best to get right up to the signing date, but practically there might be a day or two lag.
Essentially, yes. You need to be reasonably current, and the extent of these procedures, as always, depends on your risk assessment. Higher risk means more procedures.
What are some typical procedures?
Well, first, you need to understand management's own process. So, obtaining an understanding of any procedures management has established to ensure that subsequent events are identified. Do they even have a system?
Makes sense. You need to know if they're looking for these things.
Then, proactive inquiry. Inquiring of management and, where appropriate, those charged with governance as to whether any subsequent events have occurred which might affect the financial statements.
And these aren't just casual chats, right? The source gave examples, like asking about new commitments, borrowings, asset sales.
Exactly. Or asset destruction, like fire or flood, back to Sujatha's case. New contingencies, unusual adjustments, anything questioning going concern. Targeted questions.
What else?
Reading minutes is crucial. Reading minutes, if any, of the meetings of the entity's owners, management, and those charged with governance that have been held after the date of the financial statements. Key decisions often get documented there.
And if minutes aren't ready yet?
Then you inquire about what was discussed in those meetings. You also should be reading the entity's latest subsequent interim financial statements, if any. They can provide timely financial clues.
Okay, so you do these procedures, you find an event that needs adjustment or disclosure. What's the next step?
The auditor must then determine whether each such event is appropriately reflected in the financial statements. Is the adjustment right? Is the disclosure adequate?
And this links to written representations, right? SA 580.
Directly. You need to request a written representation that all events occurring subsequent to the date of the financial statements, requiring adjustment or disclosure, have been adjusted or disclosed. It's management formally confirming they've handled everything properly.
Okay, that covers the period up to the report date. Now, Phase 2, facts known after the report date, but before the financial statements are issued. What's the obligation here?
Here, the auditor has no obligation to perform any audit procedures after signing the report. You're not actively hunting for things anymore.
Nice.
But if a fact does come to your attention, maybe through the news or a whistleblower, that had you known it earlier would have made you change your report, you must respond. It's reactive duty.
Okay, so what does respond mean in practice?
First, discuss the matter with management and, where appropriate, those charged with governance. Get their take. Second, determine whether the financial statements need amendment. Does this new fact require changes? And third, inquire how management intends to address the matter. What's their plan?
Right. What if management agrees and does amend the statements?
Then the auditor has work to do again. You shall carry out the audit procedures necessary on the amendment itself. Verify the change is correct.
Okay.
You also have to extend the audit procedures to the date of the new auditor's report, because your new report implies you've considered things up to that later date.
And issue a new report.
Yes, provide a new auditor's report on the amended financial statements, dated no earlier than when those amended statements are approved. The new date is key.
The source mentioned an alternative, dual dating. When might that apply?
Yes. If the law allows and the amendment relates only to the specific subsequent event, the auditor can choose to amend the auditor's report to include an additional date restricted to that amendment.
So the report might say, report dated July 31st, except for Note X, which is dated August 15th.
Exactly like that. It limits the auditor's responsibility for that extended period to just that one specific item. It avoids having to update all subsequent event procedures to the later date. Or they could add an emphasis of matter or other matter paragraph explaining the restricted update.
Clever. Now, what if management refuses to amend the statements when you think they should?
It depends if the report has physically left your hands yet. If the report is not yet provided to the entity, then you shall modify the opinion, as per SA 705, likely a qualified or adverse opinion.
Okay, but if the report has already been provided?
Then it's more serious. You shall notify management not to issue it to third parties. Try to stop it getting out.
And if they issue it anyway?
Then the auditor shall take appropriate action to seek to prevent reliance on the auditor's report. This could mean talking to regulators, legal advice. It's about protecting the public from misleading info.
Right, a serious step. Okay, final phase. Phase 3. Facts known after the financial statements have been issued. Auditor obligation.
Same as Phase 2, no obligation to perform any audit procedures after issuance. But again, if a critical fact comes to light that would have changed the original report, you must act.
So, same initial steps. Discuss with management, determine if amendment needed, ask their plan.
Yes. If management does amend, the procedures are similar to Phase 2, but with one critical addition.
Good shiz.
The auditor must also review the steps taken by management to ensure that anyone in receipt of the previously issued financial statements is informed of this situation.
Ah, so making sure they tell people who already have the potentially misleading old statements. That's vital.
Absolutely critical for protecting those users. Management needs a plan, maybe issue revised statements, a press release, contact known users directly.
And if management doesn't take those steps or refuses to amend?
Then, again, the auditor notifies management they will seek to prevent future reliance on the report. And if management still doesn't act, the auditor takes appropriate action, like in Phase 2, legal counsel, regulators, etc. The public interest duty continues.
Okay, let's make this concrete with those scenarios. Test your understanding 1. Move Fast Limited. Flood damage. 1 crore insurance claim shown as receivable at March 31st. In April, it settled for 45 lakhs. Money received May 15th. Audit finishes end of May. Report not yet issued. Auditor's responsibility. Okay, key things here. The damage and claim existed at March 31st. The settlement in April-May provides new information about the value of that existing condition.
So it's an adjusting event.
Exactly. It provides evidence of a condition that existed at the date of financial statements. The uncertainty at year-end, how much is the claim worth, is resolved before the report is issued.
So the action is?
The financial statements for March 31st should be adjusted to reflect fresh information. The 1 crore receivable needs to be written down to the actual 45 lakhs settled. The auditor must ensure that adjustment is properly reflected. You can't issue a report knowing the receivable is overstated. It's perfect sense. Okay, scenario 2. Test your understanding 2. CA erosion proposed dividend. Audit for year ending March 31st. Board proposes a 1 crore dividend on April 17th after year end. Audit finalizing July 31st. Adjust or disclose.
This one is different. The key is the word proposed. At March 31st, was there an obligation to pay this dividend?
No, it hadn't even been proposed yet, let alone declared or approved.
Precisely. So this represents a condition that arose after the reporting period. No obligation existed at the reporting date.
Meaning it's a non-adjusting event.
Correct. It does not require recognition. No liability recorded on the March 31st balance sheet.
But it's still important information for users, right?
Yeah.
A big potential cash outflow.
Absolutely. So while it doesn't adjust the numbers, it should be disclosed in financial statements and notes to accounts. CA Anuj needs to check that this disclosure is made clearly. Getting that distinction between adjusting and non-adjusting is fundamental.
All right, let's pivot now to SA 570. This one deals with probably one of the most critical concepts in auditing, going concern.
Absolutely fundamental. SA 570 covers the auditor's responsibilities relating to going concern and the implications for the auditor's report. It's all about whether the company can realistically continue operating for the foreseeable future.
And that foreseeable future is typically how long?
Generally considered to be at least 12 months from the reporting date, sometimes longer depending on the circumstances or regulations.
Okay, and the whole idea of the going concern basis of accounting, what does that mean?
It's the bedrock assumption for most financial statements. It means we assume the entity is a going concern and will continue its operations for the foreseeable future. And that implies neither the intention nor the necessity of liquidation or of curtailing materially the scale of the operations.
So assets are valued, assuming they'll be used, liabilities assuming they'll be paid in the normal course of business, not in some kind of fire sale.
Exactly. If that assumption isn't valid, the whole basis of accounting changes, potentially drastically. Assets might be worth much less in liquidation. All debts might become immediately due.
Now, differentiating responsibilities here is crucial. Who assesses going concern first? Management or the auditor?
Definitely management. It's unequivocally management's responsibility to make specific assessment of the entity's ability to continue as a going concern.
And they also have to disclose any issues.
Yes, they need to make appropriate disclosures. If there are significant doubts or uncertainties, even if the accounting rules don't explicitly mandate it for their industry, fair presentation demands it. And this assessment involves a lot of judgment about an inherently uncertain future.
So what's the auditor's role then? We don't make the assessment.
No. The auditor's responsibility is to obtain sufficient appropriate audit evidence regarding and conclude on the appropriateness of management's use of the going concern basis of accounting. We review their assessment.
And we also have to judge if there's a material uncertainty.
Correct. Does the level of doubt warrant specific highlighting in the financial statements in our report? But, and this is important, the auditor cannot be expected to guarantee the entity's ability to continue as a going concern.
Right, we're not crystal ball gazers.
Exactly. We assess the appropriateness of management's view now based on available evidence. We don't predict the future.
So how do we, as auditors, spot potential problems? What are the red flags for going concern issues?
The standard says the auditor shall remain alert throughout the audit for indicators. They can pop up anywhere. They generally fall into a few categories.
Like financial indicators?
Yes, those are often the most obvious. Things like a net liability or net current liability position, more debts than assets, or fixed-term borrowings approaching maturity without realistic prospects of renewal or repayment. That's a big liquidity crunch looming.
What else?
Excessive reliance on short-term borrowings to finance long-term assets. A classic mismatch. Indications of withdrawal of financial support by creditors. Consistently negative operating cash flows. The core business is bleeding cash. And adverse key financial ratios. Things like current ratio, debt coverage ratios, turnover ratios, all going the wrong way.
So the numbers are screaming trouble.
Pretty much. Also, substantial operating losses or a significant deterioration in the value of assets needed to generate cash. Arrears or discontinuance of dividends often signals cash shortage. Inability to pay creditors on due dates, a very direct sign of distress.
What about dealings with suppliers?
A huge red flag is a change from credit to cash-on-delivery transactions with suppliers. It means suppliers don't trust the company to pay later. Also, an inability to obtain financing for essential new product development or other essential investments can strangle future growth.
Okay, those are financial. What about operational indicators? Things happening inside the business?
Yes, those matter too, like clear management intentions to liquidate the entity or to cease operations, maybe picked up in discussions or board minutes. The loss of key management without replacement can destabilize things.
Or losing big customers or suppliers?
Definitely. Loss of a major market, key customers, franchise, license, or principal suppliers can be fatal. Also, serious labor difficulties, persistent shortages of important supplies, or even the emergence of a highly successful competitor that just eats their lunch.
And then there are other indicators, things outside the day-to-day financials or operations.
Right, like non-compliance with capital or other statutory or regulatory requirements could lead to fines or shutdown. Pending legal or regulatory proceedings, that may result in claims that the entity is unlikely to be able to satisfy.
Changes in laws or government policy?
Yes. Changes in law or regulation or government policy expected to adversely affect the entity. And very relevant to our earlier case, uninsured or underinsured catastrophes when they occur, like that fire at Sujatha's client.
That's a long list of potential problems. Does finding one automatically mean it's not a going concern?
Not necessarily, and this is crucial. The significance of such events or conditions often can be mitigated by other factors.
Ah, so there might be counterbalancing things.
Exactly. Maybe they can sell off a non-core asset to raise cash, or renegotiate loan terms, rescheduling loans, or get a capital injection from owners, obtaining additional capital, or find new suppliers if a key one goes bust. The auditor has to weigh the negative indicators against these potential mitigating factors. Are they realistic? Are they likely to work?
Okay, so you've identified some red flags,
Yep.
maybe some mitigating factors. What additional audit procedures does SA 570 require then? This is where the real work starts, right?
Absolutely. If management hasn't already done a formal going concern assessment, which they should have, step one is requesting management to make its assessment. You need their starting point.
Assuming they provide one, what's next?
Then you have to rigorously evaluate management's plans for future actions. This isn't just ticking a box. You assess whether the outcome of these plans is likely to improve the situation and whether management's plans are feasible in the circumstances.
Feasible, meaning realistic.
Yes. If they plan to liquidate assets, are there buyers? At what price? If they plan to borrow more money or restructure debt, are banks actually willing? On what terms? If they plan to cut costs, what's the impact on the business? If they plan to raise capital, who from? How certain is it? You need evidence, not just promises.
What about cash flow forecasts? They always seem central in these situations.
They almost always are. If a forecast is a significant part of management's case, the auditor has specific duties. You must evaluate the reliability of the underlying data generated to prepare the forecast. Is it sound? Consistent? And, even more importantly, determine whether there is adequate support for the assumptions underlying the forecast. Are sales projections reasonable? Are cost assumptions realistic? Are planned savings achievable? You have to challenge those assumptions.
Got to keep looking for new information, right?
Constantly. Consider whether any additional facts or information have become available since the date on which management made its assessment. Things change fast. And, linking back again to SA 580, you'll be requesting written representations from management regarding their plans for future actions and the feasibility of these plans. Get it in writing.
What other kinds of procedures might be involved?
Oh, quite a few, depending on the situation. Analyzing recent interim financials, reading loan agreements for covenant breaches, reviewing board minutes for financing discussions, talking to the company's lawyers about litigation risks, confirming financial support arrangements and the ability of the supporter to actually provide funds, evaluating plans for fulfilling customer orders, or reviewing any regulatory actions, checking if asset disposal plans are adequate. It's a deep dive.
Okay, after all that evidence gathering, the auditor has to conclude. What are the key conclusions and the impact on the report?
Right. First, you evaluate if you have enough appropriate evidence. Then you conclude on the appropriateness of management using the going concern basis. And critically, you conclude if a material uncertainty exists.
Material uncertainty. That means the doubt is significant enough that users need to know about it specifically.
Precisely. It's about the potential magnitude of the impact and the likelihood of it happening. If it's significant, it needs clear disclosure.
Okay, let's walk through the reporting scenarios. These are crucial for exams. Scenario 1. Auditor decides the use of going concern basis is inappropriate. What's the opinion?
If the auditor concludes the going concern basis itself is wrong, the company clearly isn't a going concern, then the auditor shall express an adverse opinion.
Adverse. And that's even if management discloses that the basis is inappropriate.
Yes, this is a critical point. The adverse opinion applies regardless of whether or not the financial statements include disclosure of the inappropriateness. Disclosure cannot fix a fundamentally flawed basis of preparation. The financial statements are materially misstated if prepared on a going concern basis when it's clearly not applicable.
Got it. Adverse opinion, no matter what. Now, scenario 2. Use of going concern basis is appropriate, but UTT material uncertainty exists. This sounds more common.
It is. Here you agree the company might survive, maybe due to management's plans, but there's still a significant risk, a material uncertainty. What happens next depends on disclosure.
So if management makes adequate disclosure in the notes about this uncertainty.
If the disclosure is adequate, explaining the situation and management's plans clearly, then the auditor expresses an unmodified opinion. The financials are fairly presented overall.
But there's usually a but.
But the auditor's report must include a separate section titled Material Uncertainty Related to Going Concern.
Ah, so you flag it prominently, even with a clean opinion.
Exactly. This section serves two purposes. It draws attention to the note in the financial statements where the detailed disclosure is, and it explicitly states that these events or conditions indicate that a material uncertainty exists, and that the auditor's opinion is not modified in respect of the matter. It's a clear warning sign for users, pointing them to the details without qualifying the whole opinion.
Okay, makes sense. But what if, in that same scenario, basis appropriate material uncertainty exists, the disclosure is inadequate, management hasn't explained it properly?
If the disclosure is inadequate, then the auditor expresses a qualified opinion or adverse opinion as appropriate. The basis for opinion paragraph will specifically state that a material uncertainty exists and the financial statements do not adequately disclose this matter. You're calling out the lack of transparency.
Right. What if management just digs their heels in? They're unwilling to make or extend its assessment or provide the info you need.
That's a scope limitation. The auditor shall consider the implications for the auditor's report. If you can't get the evidence you need about going concern because management won't cooperate, it could lead to a qualified opinion, except for, or even a disclaimer of opinion if the potential impact is pervasive. You can't conclude if you don't have the evidence.
And communication is key throughout this, right? Especially with those at the top.
Absolutely. SA 570 requires communication with those charged with governance, BCWG, usually the board or audit committee. The auditor shall communicate any events casting significant doubt. This communication needs to cover whether the events constitute a material uncertainty, whether management's use of the going concern basis is appropriate, the adequacy of related disclosures, and implications for the auditor's report. Keeps them fully in the loop.
Good point. One last thing from the source, significant delay in financial statement approval. Why is that relevant?
If management is dragging its feet significantly in approving the financials after year-end, the auditor needs to ask why. If the delay seems related to struggles with the going concern assessment, maybe they can't finalize plans or secure funding, the auditor shall perform additional procedures to investigate and consider the effect on the auditor's conclusion. The delay itself can be another warning sign.
Okay, let's apply this. Test your understanding 3. CA Somia and poultry business. Poultry company, doing well. Then pandemic and bird flu hit hard. Sales collapsed, stock wiped out. CA Somia is not optimistic.
That's a tough situation.
Management has a plan. New bird badges, restructured bank loans, but no new credit. Hoping for longer supplier credit, new health measures. But villagers are complaining about pollution. Management gives Somia a cash flow forecast. How should she approach evaluating this forecast?
Okay, Somia needs to be incredibly skeptical and thorough here. She must carefully evaluate assumptions, underlying forecast, and also reliability of data. Specifically, she needs to challenge, how are they funding the new livestock without fresh bank credit? Are the assumptions realistic?
Good question.
Check the loan restructuring letters. Do the forecast repayments match the actual terms? Is it feasible? The assumption about getting longer credit from suppliers during a downturn, is that reasonable? Will suppliers actually do that? She might need to check.
What about the costs?
Has the forecast properly included the increased expenditure on new health measures? Those aren't optional now. And crucially, how are they planning to deal with the pollution issue? Is potential cost fines, legal fees, remediation factored into the forecast? Any one of these could derail the plan and the going concern assessment.
Lots to dig into there. Okay, last scenario for this part. Test your understanding 4. CA Suraj and key financial ratios. Ratios in red, can't pay bills or salaries, big losses, bankers refusing more credit. Suraj concludes going concern basis is not appropriate. He tells the CFO, who surprisingly agrees and says they'll disclose the inappropriateness. What's Suraj's reporting duty? Does the CFO's agreement to disclose change anything?
This is a classic trap. The key fact is Suraj concluded the going concern basis is inappropriate. Therefore, according to SA 570, he shall express adverse opinion. Full stop.
Even though the CFO agreed to disclose it.
Yes. And this is the absolute critical takeaway. Even if management discloses that its use of going concern assumption is inappropriate, it would have no impact on auditor's opinion. He would need to express adverse opinion.
Why? Why doesn't the disclosure help?
Because the disclosure doesn't fix the underlying problem. The financial statements themselves are prepared on a basis, going concern, that is fundamentally wrong. They are therefore materially misstated. Disclosure can't correct a material misstatement stemming from an inappropriate accounting basis. The auditor's job is to report that the statements as presented are not fair.
Okay, let's move on to the third piece of this puzzle. SA 580, written representations. What's the focus here?
SA 580 deals with the auditor's responsibility to obtain written representations from management and, where appropriate, those charged with governance. It's about getting formal, signed statements from them on key matters.
So it's part of the audit evidence.
Yes, the standard says written representations are necessary information that the auditor requires. They are definitely part of the evidence base. However, and this is a really important distinction, although written representations provide necessary audit evidence, they do not provide sufficient appropriate audit evidence on their own.
So getting the letter isn't enough by itself.
Absolutely not. They support other evidence you've gathered through procedures, but they don't replace those procedures. You can't just rely on the letter. You need corroborating evidence from your own work. Think of it as confirmation, not primary proof.
Okay, that's clear. What are the auditor's main objectives in getting these representations?
There are three main goals. First, and fundamentally, is to obtain written representation. Management believe that they have fulfilled their responsibility for the preparation of the financial statements and for the completeness of the information provided to the auditor.
So management formally taking ownership for the financials and for giving you everything.
Exactly. It's their explicit acknowledgement of those basic responsibilities.
What's the second objective?
To support other audit evidence relevant to the financial statements or specific assertions by means of written representations. So using the letter to bolster conclusions you've already formed based on other work like about inventory valuation or litigation completeness.
And the third?
To respond appropriately to written representations provided, or if they do not provide, knowing what to do if you get the letter, or if they refuse to give it to you.
Right. What are the key written representations that are always required?
They must come from management with appropriate responsibilities and knowledge. Usually the CEO and CFO, people who actually know what's going on and are responsible.
And they cover management's core responsibility.
Yes. Specifically, two big areas. First, preparation of financial statements, confirming they've fulfilled their duty to prepare the statements according to the rules, including fair presentation. Second, information provided and completeness of transactions, confirming they've given the auditor all relevant information and access, and that all transactions have been recorded and are reflected. Basically, confirming they haven't hidden anything.
Are there other representations required besides those two?
Yes. Other SIs might require specific ones. We saw examples in SA 560, subsequent events, and SA 570, going concern plans. The auditor might also decide additional reps are needed for specific circumstances, maybe about complex estimates, related party dealings, or compliance with laws.
Okay. What about the timing and period covered? Is that important?
Crucially important. The date of the written representation shall be as near as practicable to, but not after, the date of the auditor's report.
Why is that so critical?
Because the auditor's report covers events right up to its date. If the rep letter is dated, say, a month earlier, there's a gap. Management hasn't confirmed things for that final month. You need the representation to cover the same period as your opinion.
And the period covered by the letter.
It shall be for all financial statements and periods referred to in the auditor's report. Even if current management wasn't there the whole time, they take responsibility for the entire set of financial statements being presented now.
How are these usually provided? Just an email?
No, typically in the form of a representation letter addressed to the auditor, a formal signed document. The source mentions that sometimes, very rarely, formal public statements by management might substitute if they cover the same ground, but usually it's a specific letter requested by the auditor.
Now, what if things go wrong? What if you have doubt as to reliability of the representations, or management just doesn't provide them?
If the representations seem inconsistent with other audit evidence, say, the letter says no related party transactions, but your testing found several, the auditor shall perform audit procedures to attempt to resolve the matter, investigate the discrepancy.
And if it can't be resolved?
If it's unresolved, you have to reconsider the assessment of the competence, integrity, ethical values, or diligence of management. Their credibility is shot. This impacts all evidence you got from them. If you conclude the representations are not reliable, you take appropriate action, probably modifying the audit opinion under SA 705.
What if they just flat out refuse?
Yeah.
Requested written representations not provided.
That's a huge red flag. First, discuss the matter with management. Try to understand why. Then reevaluate the integrity of management. If they won't provide this basic letter, what else aren't they telling you? Evaluate the impact on the reliability of all their assertions and evidence. Then take appropriate actions, including determining the possible effect on the opinion in accordance with SA 705.
And there's a critical consequence here, right? Especially regarding those core representations about responsibility.
Yes, this is a massive point for exams and practice. If those specific representations about management's fundamental responsibilities for preparing the financials and providing complete information, paragraphs 9 and 10 of SA 580, are either deemed unreliable due to integrity doubts or simply not provided, The auditor shall disclaim an opinion on the financial statements.
Disclaim, meaning you issue a report saying you can't give an opinion.
Exactly. Why? Because the inability to get these foundational representations is considered pervasive. It undermines the entire audit. If management won't even affirm their basic responsibility for the numbers and the information, you lack the fundamental assurance needed to form any opinion. It's a complete breakdown, leading to a disclaimer.
Wow. Okay, let's apply this. Test your understanding 5. Arrest limited written representation anomaly. Rep letter dated April 15th, 2023. Audit report dated July 31st, 2023 for year ending March 31st. What's the anomaly? What's the implication?
The anomaly is pretty clear. A considerable lag between date of written representations and date of audit report. 3.5 months.
And the standard says it should be dated as near as practicable to, but not after the report date.
Correct. So the implication, this gap could signify that all subsequent events after date of financial statements requiring adjustments or disclosure may not have been adjusted or disclosed by management.
Because the letter doesn't cover that period from April 15th to July 31st.
Exactly. The auditor's report implies consideration of events up to July 31st, but the management rep doesn't confirm anything for that last stretch. The auditor must address this gap, get an updated letter dated nearer July 31st, or perform significant additional procedures to cover that intervening period themselves. It points to potentially missing information.
Okay, now for the big finale. Let's tie all three of these standards, 560, 570, and 580, together using that integrated case study. Infinity Hospitality Private Limited. This is exactly the kind of thing you might see in an exam testing everything we've discussed.
Right, a complex scenario demanding integrated thinking. Let's quickly recap the key facts.
Okay. Infinity Hospitality, set up in '96, runs hotels in Kerala on long-term leases, 10, 12 years, big lock-in periods, and critically, the leases have no force majeure clause.
Meaning they're stuck paying rent even if disaster strikes.
Precisely. Their structure is debt-oriented and over-leveraged, and the owners always took profits out, leaving no contingency reserves.
A recipe for trouble when things go wrong.
And things went very wrong. The double whammy. First, massive Kerala floods wiped out tourism, caused access problems. Then, before they recovered, the pandemic hit, stopping travel completely.
Devastating for a hospitality business.
Management, though, remained optimistic, hoping for government help and deals with lessors and banks. They kept paying staff, deferring 25%. But basically, business ground to a halt. The auditors, MSYZ and Associates, are now grappling with the situation.
A perfect storm testing going concern, subsequent events, and the need for reliable representations.
Exactly. So, let's tackle the questions. Question 1. Given these facts, what specific additional audit procedures must the auditor undertake as per SA 570 to determine if a material uncertainty exists regarding going concern?
Okay, given Infinity's dire straits, the auditors need to go way beyond standard procedures. They must be analyzing and discussing cash flow, profit, and other relevant forecasts with management. Really digging into those assumptions, are they just wishful thinking given the floods and pandemic aftermath?
Scrutinizing the numbers. What else?
Analyzing and discussing the entity's latest available interim financial statement. See if trends have worsened or improved since year-end. And crucially, reading the terms of loan agreements and determining whether any have been breached. Are they already in default? Are the banks about to pull the plug?
Checking minutes, too.
Yes. Reading minutes of the meetings of shareholders, those charged with governance and relevant committees for reference to financing difficulties. What are they really discussing internally? Also, inquiring of the entity's legal counsel regarding the existence of litigation and claims, like those lease issues without force majeure or any potential fallout from deferred salaries. What's the likely outcome and financial impact?
What about external support? Management was hoping for help.
The auditor needs to be confirming the existence, legality, and enforceability of arrangements to provide or maintain financial support, and assessing the financial ability of such parties to provide additional funds. If management says a parent company will bail them out, you need proof of the commitment and proof the parent actually can provide the funds, especially vital here with no reserves.
And the link to subsequent events.
Absolutely key here. Performing audit procedures regarding subsequent events to identify those that either mitigate or otherwise affect the entity's ability to continue as a going concern. Has any government aid actually materialized after year-end? Have lessors agreed to deferrals? Has a new investor shown interest? These could be game changers.
Other procedures? Borrowing facilities?
Yes.
Management's plans?
Yes, confirming the existence, terms, and adequacy of borrowing facilities. If management hasn't done a formal assessment, requesting management to make its assessment, then rigorously evaluating management's plans for further actions, critically assessing whether the outcome is likely to improve the situation and whether the plans are feasible, like plans to liquidate assets, hotels, borrow money or restructure debt, from whom materials impact or increase capital. Feasibility is everything.
And constantly updating.
Yes, considering whether any additional facts or information have become available since management made its assessment. And finally, the SA 580 link. Requesting written representation from management regarding their plans for future actions and the feasibility of these plans. Lock down their assertions.
Okay, that's a lot of procedures. Now, question 2. Before performing those detailed procedures, what risk assessment procedures should the auditor consider for arriving at a conclusion on going concern? This is about the initial planning.
Right, the starting point. The auditor shall consider whether events or conditions exist that may cast significant doubt. An initial scan for red flags based on understanding the business. Determine if management has already done a preliminary assessment.
And discuss it with them.
Yes. Discuss the assessment with management and determine whether management has identified events and conditions that cast significant doubt. And if so, management's plan to address them. Get their initial view.
For Infinity Hospitality specifically, what should the auditor really focus on in this risk assessment phase?
The source highlights 3 critical factors. The auditor shall specifically draw attention of management on and get the response on how they plan to address them. First, the company is debt-heavy and over-leveraged. This structural weakness amplifies every shock.
Second,
the leased properties are having considerable lock-in period with absence of force majeure clause. This contractual rigidity is a massive problem when revenue collapses.
and third,
There are no contingency reserves available with company, no safety net whatsoever. All these factors shall be taken into account while performing risk assessment procedures. They scream high risk and dictate the focus of the detailed audit work.
Okay. Now, question 3. What should be the auditor's approach if management agrees a material uncertainty exists but believes the entity is still a going concern? And what are the reporting requirements?
This is that nuanced scenario we discussed earlier. If the auditor concludes management's use of the going concern basis is appropriate, maybe their plans are plausible, though uncertain, but a material uncertainty exists, the auditor first checks the disclosures. They shall determine whether the financial statements adequately disclose 2 things. First, the principal events or conditions that make a significant doubt and management's plan to deal with these events or conditions. Transparency about the problem and the plan.
And second,
They must disclose clearly that there is a material uncertainty related to events or conditions, and therefore that it may be unable to realize its assets and discharge its liabilities in the normal course of business. A clear warning about the risk.
what might those disclosures include?
Things like management's evaluation of the significance of the events, significant judgments made by management, disclosures about the magnitude of the potential impact, and the likelihood and timing, giving users real context.
And the reporting requirement if disclosure is adequate.
If disclosure is adequate, the auditor shall express an unmodified opinion, but the report shall include a separate section under the heading Material Uncertainty Related to Going Concern.
And that section does what again?
It draws attention to the note in the financial statement that discloses the details and states that these conditions indicate a material uncertainty, but the auditor's opinion is not modified in respect of the matter. It flags the issue prominently without qualifying the overall opinion.
Got it. Now, question 4. What if the auditor believes the entity is not a going concern, but management refuses to accept it? The big disagreement.
Simple but stark. If management has prepared financial statements using the going concern assertion to which auditor differs, as according to his judgment, the going concern assertion is not appropriate, then the auditor is required to express an adverse opinion.
Adverse, because the fundamental basis is wrong.
Exactly. Management's disagreement is irrelevant to the auditor's duty if the evidence clearly points to the inappropriateness of the going concern basis.
Okay. And finally, question 5. What kind of written representation does the auditor need in this scenario from Q3? Material uncertainty exists. Going concern basis, okay, adequate disclosure. Linking back to SA 580.
In that specific scenario, the auditor needs that confirmation from management about their plans. So, The auditor needs to obtain written representation from management and, where appropriate, those charged with governance regarding their plans for future action and the feasibility of these plans. It formally documents management's assertions about how they intend to navigate the uncertainty.
Well, that was definitely a deep dive. We've covered a huge amount of ground on these critical completion and review standards. We haven't just gone over the theory of SA 560, 570, and 580, but really looked at how they work in practice in those messy, complex situations like the case study, the kind you'll definitely encounter in exams and in your career.
Absolutely. It's about connecting the dots between the standards and the real world. So, to quickly recap the core learning, SA 560, subsequent events. It's absolutely essential for ensuring financials reflect everything significant right up to the report date. We saw the importance of classifying events, adjusting versus non-adjusting, and how the auditor's response changes dramatically depending on when facts become known. It's all about timing and vigilance.
Right. Then SA 570, going concern, the bedrock assumption. We saw how auditors assess management's judgment, hunt for those red flags, perform really rigorous additional procedures, and then land on the right reporting outcome, understanding that crucial difference between highlighting a material uncertainty with disclosure versus issuing an adverse opinion if the whole basis is wrong.
And SA 580, written representations. A vital piece of the puzzle, but, as we stressed, not sufficient on its own. It's management's formal confirmation of their responsibilities and intentions. We saw how critical its reliability and timing are, and the ultimate consequence potentially a disclaimer if those fundamental reps aren't forthcoming or reliable.
What really stands out to me looking back is just how interconnected they are. You can't really think about them in isolation, can you?
Not at all. The Infinity Hospitality case showed that perfectly. Subsequent events procedures, SA 560, directly informed the going concern assessment, SA 570, and both relied on getting specific written representations, SA 580. It's an integrated system designed to ensure a true and fair view.
And mastering this isn't just about exam points, is it?
Far from it. Yes, it will help you nail those case studies, but fundamentally, it's about developing the critical judgment and practical skills of an effective auditor. It's about protecting stakeholders by ensuring financial statements are reliable, which is crucial for trust in the markets.
That's a really important point. So maybe a final thought for our listeners to ponder. As information flies around faster and faster, and global events like pandemics or climate issues create such rapid shifts, think about this. How might real-time data and faster business transactions squeeze that subsequent events timeline even more?
Interesting question.
Will that traditional data the auditors report become more fluid, more dynamic, pushing the boundaries of what subsequent even means? And how will this faster pace impact how we assess going concern and define that foreseeable future? What new challenges, maybe even opportunities, does this create for auditing?
Definitely food for thought. The profession is constantly adapting, and these pressures are very real.
Indeed. Well, that's all for this deep dive. We really hope this session has given you the insights and the clarity you need to tackle your studies, your exams, and your future career with more confidence.
Hope it was helpful.
Until next time, keep digging deeper.